In 2023, Lululemon was unstoppable. This Vancouver-based athleisure giant just hit a massive $9.6 billion in annual revenue, a 19% surge that marked a back-to-back double-digit growth. The company's stock closed out 2023 at an all-time high of $511 per share, up more than 50% in that year alone. Lululemon was arguably at the height of its cultural influence. The silver Omega logo was an infection. You simply couldn't escape those leggings. With 700 stores and a cult-like following, the brand that turned yoga pants into a global status symbol looked like it would grow forever. And fast forward to early 2026, things look very different. The company's stock has plunged nearly 70% from its peak, and last year's revenues rose just a mere 5%. And in the most damning sign, North American sales actually fell for the first time ever. Once sold-out stores are now grappling with weaker foot traffic and rising markdowns. Meanwhile, fashion-forward rivals and low-cost copycats are nibbling away at Lululemon's market share. So, what happened? How did a beloved, high-flying brand lose its mojo so quickly? The causes of Lululemon's decline are complex, but generally, they can be traced to four key factors. Lululemon could do no wrong. Even during the pandemic, when most brands were struggling, demand for some Lulu stuff kept climbing. Sales soared, revenue more than doubled in just a few years. And by 2022, the company launched the Power of 3 by 2 plan, aiming to double revenue again. Confidence was sky high. Investors and management trusted the formula: grow existing stores, add men's apparel and footwear, and expand globally. Everything pointed to double-digit growth for years to come. But then, North America began to slow. The market that had fueled Lululemon's rise has stalled. International sales kept climbing, but the core market no longer carried the company. North American sales went from surging to flat, and in some cases, even slipped. The sudden shift stunned the analyst. What had once been a roaring engine of growth flattened almost overnight. Consumers pulled back, even affluent shoppers grew cautious. As recession fears were growing, spending shifted towards necessities. Categories that had once boomed struggled to keep pace. High expectations collided with tough year-over-year comparisons. High-growth retail stocks fell out of favor, and management had to trim forecasts again and again. Confidence has wavered, and the unstoppable story now looked fragile. Strategic growing pains added pressure. The company had ramped up its cost structure from supply chain capacity to a rapid pace of store openings, anticipating continued high growth. But when sales slowed, expenses remained high and inventory built up in certain categories, squeezing those margins. New US import tariffs, combined with a weak product lineup, further hurt profits, with an estimated $240 million impact on gross profit in 2025. To offset this, Lululemon raised prices on some products while simultaneously discounting others to clear slow-moving inventory. These moves protected margins, but risked reducing demand even further. And by 2025, a company that had once grown more than 40% a year faced single-digit increases. Revenue targets that had once felt within reach now seemed distant. North America had gone from engine to drag. Lululemon had bet big, and the market refused to keep up. The company became a cautionary tale. Even the most unstoppable brand can overreach when ambition outruns reality. Lululemon's success was built on great products: the Align pant, the Define jacket, the ABC joggers. that customers raved about and imitators scrambled to copy. But in recent years, Lululemon's product engine stalled. The company's lineup failed to evolve at the pace of consumer tastes, and several highly touted innovations ended in embarrassment. At the end of the day, how many more pairs of leggings can one person keep buying? Even Lululemon's own CEO admitted, "Our women's business has slowed. The most significant factor is a lack of new styles. We simply did not have enough to inspire her to purchase." In other words, even as the brand offered the same beloved core items, it just wasn't injecting enough freshness to entice repeat buyers. Sun Cho, Lululemon's influential chief product officer, resigned in mid-2024 after a 6-year tenure, which briefly rattled investors who feared the pipeline of new ideas might dry up even further. But Lululemon quickly tried to reassure markets by elevating a new head of design and tweaking its product development structure. When Lululemon did push something new, the results were mixed, at times disastrously so. The poster child is the breathe-through legging debacle. After months of hype around a lightweight yoga pant designed to feel barely there, the product launch became a PR nightmare. Customers hated the pant's odd V-shaped seam that ran high up the back. I'm sure Lululemon's PR team had a blast with those TikTok reviews and long Reddit chains. Within weeks, Lululemon pulled the $98 leggings off its website and store shelves. The company spun it as test and learn failure. But it was a glaring hit to Lululemon's reputation for top-tier apparel design. The swift recall also demonstrated a deeper issue. Some of Lululemon's famed product intuition, knowing what the customer wanted before she does, seemed to be missing the mark. Quality control, long a Lululemon's hallmark, also slipped. In early 2026, Lululemon suffered a flashback to its notorious 2013 see-through pants scandal. The culprit this time was the new Get Low leggings, launched for high-intensity training. Almost immediately, buyers began complaining on social media that the tights became see-through when they bent over. Definitely not the kind of transparency customers wanted from their yoga pants. Within days, Lululemon paused online sales of the Get Low line, and a senior executive had to inform employees that customers should try wearing different underwear and perhaps size up to mitigate the issue. The episode was another self-inflicted black eye, reinforcing a narrative that Lululemon was losing its quality edge. Then there was Mirror, Lululemon's ill-fated foray into home fitness devices. While not an apparent product, the $500 million acquisition of Mirror in 2020 was framed as a bold product move, an expansion beyond closing into hardware and digital content. It turned out to be a costly disaster. As people flocked back to gyms and studios after the lockdown, demand for Mirror's workout screen evaporated. By the end of 2022, Lululemon took a $443 million impairment charge on Mirror, essentially admitting it had vastly overpaid. In 2023, the company decided to discontinue the device and struck a partnership with Peloton to offload its content instead. The Mirror saga drained resources and management attention that could have been deployed to Lululemon's core product lines. For a brand that built its empire on innovative clothing, the failed detour into tech highlighted a broader issue. Lululemon's innovation focus had drifted, and it wasn't delivering must-have apparel like it used to. Taken together, these misfires painted a picture of a company that, somewhere along the way, lost some of its product mojo. Lululemon was still introducing new products, but fewer of them were resonating as big hits, and a few turned out to be an outright flops. The risk of such stumbles is especially high for a premium brand. A couple of high-profile mistakes can make loyal customers question whether your quality and creativity are still superior. And if they begin to doubt, plenty of other options await. Lululemon had incredible success and spent 20 years building a cult. Suburban moms and college students became a walking billboard for the brand. That silver logo was the ultimate symbol of being cool in the swing class or the grocery store. Its stores offered community yoga classes. Its shopping bags quoted inspirational mantras. The brand's meteoric rise was a masterclass in building cultural relevance. Lululemon made yoga pants aspirational, turning functional activewear into a badge of wellness chic that people proudly wear all day. But in the fickle world of fashion and retail, staying cool is perhaps the hardest challenge. And by 2026, Lululemon's cool factor had begun to wane. The first warning sign came from the pillar of youth culture, the teenagers. After dominating brand survey for years, Lululemon slipped in the rankings. In the 2024 survey, Lululemon, which had been the #1 apparel brand for upper-income teen girls from 2021 through 2023, fell to #3. These were startling shifts for a brand that, not long before, was the go-to attire for style-conscious young women. The message was pretty clear. Lululemon was no longer the automatic choice for the next generation. You might ask, why? Well, in part, the rest of the world caught up. In the 2020s, Lululemon virtually was the athleisure trend. By 2020s, that trend had become global and mainstream, and fragmented as well. The market filled with competitors offering similar products for new audiences, often at a different price points. At the time, boutique upstarts like Alo Yoga and Vuori emerged with fresh styles and savvy influencer marketing, cultivating aspirational brand images of their own. Traditional sportswear giants like Nike and Adidas dabbled down on their women's lines in casual wear, and retailers like Target and Amazon flooded the market with inexpensive Lulu dupes. Lululemon's competitive moat, its unique brand appeal and product differentiation, slightly narrowed in just a few years. Alo Yoga, for example, saw its sales grow 276% from 2021 to 2024, thanks to their trendy designs and relentless social media promotion. During that same period, Lululemon's sales grew only 14%. Not bad, but nowhere near Alo's pace. Analysts found that once Lululemon customers started buying from Alo, their spending at Lululemon actually declined over time, as they directed more of their athleisure wallet to the newer brands. Beyond Alo and Vuori, even Lululemon's traditional rivals have raised their game. Gap's Athletica chain, for instance, leveraged its lower price points and expanded styles to attract value-conscious women, while Nike's brand power with men and growing focus on yoga gear has kept many customers in their camp. Simply put, Lululemon is no longer the top choice for premier activewear, and in some circles, it's not even their second preferred choice. Perhaps the brand's core aesthetic was so pervasive that it started to feel too common, and no longer the fresh status symbol it once was. Lululemon's own founder has been vocal on this point. In his open letter, Chip Wilson argued that by straying from its niche and trying to be everything to everyone, Lululemon had diluted its brand identity. He accused management of allowing a Gapification of the brand, comparing Lululemon to Gap, a once hit apparel chain that lost its edge. Wilson said that the company had lost 50% of its market cap earned from brand power and forfeited the exclusivity and excitement that originally fueled its rise. In his view, Lululemon's leadership became too focused on broad, short-term growth and not focused enough on the core customer, the muse, as he calls the yoga-inspired women who were the soul of the brand. There is some truth in Wilson's critique. Lululemon's marketing and product strategy in recent years lack the provocative spark of its early days. The brand, once famous for think fast, be bold design, has at times seemed reactive and even behind the curve. For example, Lululemon was slow to capitalize on certain crazes, like the resurgence of vibrant print leggings and flared yoga pants, ceding those trends to competitors. It's not that Lululemon's brand was tarnished outright. The company maintained a strong base of loyalists and still holds a 21% share of the US athleisure market, second only to Nike. But that aura was no longer there. Shoppers started to explore alternatives, whether for novelty, price, or both. The challenges I mentioned earlier were exacerbated, and in some cases, caused by missteps at the leadership level. Lululemon's management, while great at scaling the business, made some decisions that in hindsight undermined the brand's long-term strength. Chief among them was the mirror that I mentioned earlier, a move that burned roughly $500 million in the shareholder capital and ended up almost worthless. But mirror was not the only strategy that sent the stock to freefall. As Lululemon grew from a niche yoga apparel seller into a global retail empire, insiders say that company slowly shifted from its product-focused roots to a more traditional corporate mindset. The charismatic founder was long gone from management, and the new CEO, Calvin McDonald, emphasized global expansion and operational efficiency. Under McDonald's tenure, Lululemon did achieve impressive top-line results for a time, where revenues roughly tripled from 2018 to 2023. But this came with a creeping loss of what Wilson calls the singular voice for product and long-term strategy. In founder's opinion, Lululemon board became dominated by financially oriented directors who prioritized hitting quarterly targets. He paints a picture of a company that started to manage more by a spreadsheet than by inspiration, which in fashion business can be a fatal shift. Whether or not one agrees with Wilson's full assessment, it's clear that instability at the top did Lululemon no favors. As growth slowed and problems mounted, the company's troubles were met with frequent executive turnover and strategic zigzagging. In addition to the exit of the chief product officer, Lululemon in early 2022 lost its chief operating officer and its chief brand officer. These departures, combined with the power in the C-suite, raised concerns about an internal culture in flux. Wilson claims that many of Lululemon's most talented product people left during this period, sometimes to competitors, and they were replaced by Nike executives who simply import their business model. The implication is that Lululemon's unique culture of innovation was diluted by an influx of traditional retail thinkers, contributing to the status quo mindset that hurt its product strategy. As Lululemon's stock spiraled down and US sales continued to disappoint, the founder, Chip Wilson, still a large shareholder, took his fight to the public, releasing open letters and that full-page newspaper ad destroying the board. And in December 2025, Lululemon made the first of several big moves. CEO Calvin McDonald resigned under pressure, ending a tenure that saw rapid expansion followed by a swift downfall. The board installed 2 co-CEOs on an interim basis and launched a search for new leadership, effectively admitting that a fresh direction was needed. In March of 2026, Lululemon added Charles "Chip" Berg as a well-regarded turnaround expert and former Levi's CEO to its board of directors. The infamous founder called the choice underwhelming and criticized the board's failure to consult him. In the eyes of many observers, these governance changes were long overdue. Now, with new blood like Berg and the prospect of an outsider, there is hope that Lululemon can regain some of its lost discipline and creativity. In just 2 years, Lululemon traveled from hot market leader to a cautionary tale. Its descent illustrates how even strong brands can falter when they lose sight of their core strengths and customers. Lululemon grew at a crazy speed, but in chasing even higher sales, it arguably overextended and outpaced its ability to execute. The company's leadership bet heavily on continuous growth, ventured outside its lane, and failed to notice that the marketplace was changing around them until the evidence was overwhelming. Meanwhile, the lifeblood of the brand, product innovation and cultural resonance, was diluted. Lululemon let its once keen edge get dull, and competitors, changing consumer taste, rushed in to fill the void. In a sense, Lululemon became a victim of its own success. Its product became so popular that they stopped feeling fresh, and the brand didn't have a next act ready when the world moved on. Maybe the founder was kind of right. The leadership became too focused on the spreadsheet and too little on the muse. The silver lining is that Lululemon remains a robust company underneath the noise. It's still profitable and still holds a strong position in the market. The ongoing reset at the top offers a chance for Lululemon to course correct. The plan, as the interim CEOs have signaled, is to double down on what originally made Lululemon great, innovating great products and delivering premium experiences. That means putting creative design first, focusing on core customers, and refusing to chase the competition. In effect, Lululemon is trying to rekindle the entrepreneurial spark it had in its early days, but now within a $10 billion global enterprise.
I understand that people buy it for fashion, but that's their choice. It's my thinking is always athletic and functional. Of course, the posers are what makes any kind of clothing company financially successful.
The biggest lesson from Lululemon's stumble is to remember never take your success or your customers for granted. In the span of few short years, tastes can change, competitors can multiply, and a brand that seemed on top of the world can find itself scrambling. Protecting a strong brand requires constant reinvention and vigilance. Lululemon learned this the hard way. Now the question is whether it can apply those lessons, recentering on product, culture, and customers to win again. Company's rise was extraordinary, and its fall was swift. Its future will depend on how effectively it can reconnect with the ethos that made Lulu a household name in the first place, and whether it can once again lead rather than follow.